What's up guys, Jake here. If you clicked on this video, then potentially in the near term you are looking to buy a house and maybe you've heard of the three kinds of mortgages that you can apply for. In this video, let's cover the three and go over their differences. But before we do, I just want to tell you that I am not a mortgage lender, I am not a real estate agent, I'm not trying to sell you anything in this video. I'm just some guy on YouTube that likes making educational content. If you like these kinds of videos, give me a thumbs up. Really helps out the channel. So the three kinds of conforming loans are VA, FHA, and conventional. VA standing for Veterans Administration. This is only for veterans. FHA standing for Federal Housing Administration. And then conventional just being the most common type. Now, VA and FHA are government insured. They're loans backed by the government, whereas with conventional, they are not. Now, the question you might have immediately is, what does that mean, a conforming loan? And a conforming loan is a set of guidelines that lenders have to follow in order to resell your mortgage to one of the mortgage security companies. Maybe you've heard of Freddie Mac, Fannie Mae, or Ginnie Mae. 99.9% of all mortgages, when you go through a lender, doesn't matter if it's a credit union, Chase Bank, Wells Fargo, one of the national lenders like Rocket Mortgage or Loan Depot, 99.9% of all home loans are repackaged and sold as securities through Freddie Mac and Fannie Mae. So these are the companies that you're actually going to be paying for 30 years, not your local bank or credit union. Now, if you don't meet the criteria for a conforming loan, it is still possible to partner with a bank or a credit union. These are called portfolio loans. It just means that that specific bank or credit union has to hold on to your mortgage for the lifetime of the loan. In general, banks and credit unions don't like doing those kinds of loans because it ties up their capital for 30 years. They would much rather rapidly go in and out of deals, reselling those to the mortgage security companies. First thing you need to know is that if you're buying an investment property or a second home or a vacation home, you're not eligible to use FHA or VA. You have to use a conventional loan if you're going to immediately start renting it out or otherwise not living in it as your primary residence. So for FHA and VA, this is only for first-time home buyers. So if you're watching this video, I'm assuming that you are a first-time home buyer. Now on my channel, I've already dedicated a video to the VA loan in the event you are a veteran or a spouse of a deceased veteran. You can go down below, check that video out. It will go into much greater details about the VA loan process. So in this video, let's focus on the differences between conventional and FHA. Here's basically what you need to know about an FHA loan. And in general, FHA loans have a lower credit score requirements. Some lenders will want you to have a 600, some lenders will go lower into the 500s. Whereas with a conventional loan, they're really going to want to see a 620 credit score. And then once you're above 740, you should be eligible for the most favorable lending terms. FHA loans are also more flexible with life events in the event that you've had a recent bankruptcy or foreclosure. In addition, with an FHA loan, you only have to put down 3.5% of the cost of the home, which is a pretty low down payment. Now with a conventional loan, what you can get varies greatly depending on your credit score and how much of a down payment you can provide on the house. So with lenders, they want to see at least a 620. Once you're above 740, you should get the most favorable interest rates. With down payments, you can put down as low as a 3% on a conventional loan, but once you're above 20%, that will give you the most favorable lending terms. So in general, with a conventional loan, the higher your credit score and the more of a down payment you can get, the lower the interest rates and the lower the private mortgage insurance you have to pay. We'll talk more about that in a second. Once you're above 20% down payment on a home, you don't have to worry about mortgage insurance. So here are the specific numbers that lenders will tell you if you apply for a conventional FHA or VA loan. If you've had a bankruptcy in the last 4 years, this will make you ineligible for a conventional mortgage. FHA 2 years, VA 2 years. If you've been foreclosed on a house prior with conventional, you are limited within the last 7 years. FHA, it's much more reasonable to, once again, life events. 3 years, and with VA, the most favorable, only 2 years. The next big difference between the three kinds of loans is your debt-to-income ratio. When your lender looks at your tax returns, your bank statements, and your pay stubs, they're going to determine what is your gross income and what ratio is that to your current debt payments. So they're going to factor in student loans, credit cards, car payments, personal loans, child support, alimony, and then factor in the potential house payment that you would have to make if approved for the loan. And with a conventional, they don't want you going above 50%. So it's the range is between 50 and 45. But with an FHA, they're willing to have this go higher to 50%, and then with the VA, they're willing to go higher than 60%. However, I don't recommend this. You shouldn't do this. Whatever you're approved for from your lender with any of these kinds of loans, that doesn't mean you should or need to max it out. If you're approved for a $500,000 mortgage, you can still buy a $200,000 home. When you overpay on a house and your mortgage ends up taking up more than a third of your gross take-home pay, you can end up being house poor. So just know that your lender is telling you what the max limit they would allow. That's not the amount you should be paying for your home. Now, the biggest difference between FHA and conventional is between mortgage insurance premium and private mortgage insurance. These are basically accomplishing the same thing with respect to your loan, but they have two different names. With the VA, it has a VA funding fee, but there is no mortgage insurance on a VA loan. So what are these? Well, PMI with a conventional loan is required if you put down less than 20%. This is a fund that everybody pays into to cover the losses that lenders incur when people default on their mortgage and are foreclosed on. So if somebody stops paying their mortgage, somebody somewhere is going to lose money having to go through the foreclosure process to have you kicked out and then put that house back on the market and resell it. So PMI pays for these programs basically so that lenders are not losing money. So if you don't want to pay PMI, then put down greater than a 20% down payment on a conventional loan. If you don't have that 20%, don't worry. With a conventional loan, this insurance that you're paying every month drops off once your equity to loan ratio is 80-20. So once you've paid off or have built equity in the home greater than 20%, PMI should go away. And what's nice about a conventional loan is that as your house appreciates in value, this helps with this ratio. So if you only put down initially 3%, 5%, 10%, but your house appreciated 10% in a year, that goes towards your ratio of 80-20 to get rid of PMI. Nobody wants to pay this. Additionally, with a conventional loan, there is no upfront mortgage insurance. This is something that only exists with FHA loans, and their program is called MIP. But in addition to MIP, you're going to pay the upfront mortgage insurance, which is 1.75% of the mortgage financed into the loan and then amortized and paid over the lifetime of the loan, 30 years. And unlike a conventional loan where once the equity in the home is greater than 20%, you can stop paying it, with an FHA, you have to continue paying MIP forever. So how much is it? I'm hesitant to give you numbers because HUD policy can always change in the future. So ask your lender, check with your lender what your mortgage insurance payments would be on an FHA. But right now, when I Googled it, you can calculate it by saying 0.5% multiplied by the cost of the loan divided by 12 is your monthly payment. So if you bought a $200,000 home, your mortgage interest payment would be $84 a month. And that's for all 30 years. This never goes away with an FHA loan. And basically what FHA is telling you is that you are high risk forever because maybe you had a more recent foreclosure or bankruptcy, or you had a lower credit score. They're going to keep making you pay this mortgage insurance, $84 a month, for the entire lifetime of the loan. So at this point you might be asking, well then what's the advantage of FHA? And historically, traditionally, FHA loans have had a lower interest rate than a conventional loan. So the same person with the same credit score and the same down payments on a conventional would get a lower interest rate through FHA. That has been the advantage, and that actually can easily overtake the cost of the additional mortgage insurance. But it all depends on the factors. It depends on the base interest rates. So when doing a conventional loan, how much you put down really matters in how much you'll pay in private mortgage insurance and interest rate. Generally, if you pay between 3 and 5, you'll see a difference once you get between 5 and 10, and then you'll see a difference between 10 and 20. And of course, if you're buying a second home or an investment property, you have to go conventional and your interest rates will be higher. The reason why is because if you have two homes, your second home, if you're experiencing financial difficulty, your second home is the one more likely that you're going to stop making the mortgage payment on. You're more likely going to keep paying the mortgage on the house you're physically living in. So second homes and investment properties are considered higher risk, therefore you have to pay a higher interest rate. So what are my final thoughts on the three kinds of loans? Well, first of all, with a VA loan, if you are a service-disabled vet, meaning you have a greater than 10% disability rating, then definitely go with a VA loan. It's no money down, you don't have to pay the VA funding fee, and there's no mortgage insurance. So VA loans, especially if you're a service-disabled vet, are pretty fantastic. But between a FHA loan and a conventional loan, well, if you've had a bankruptcy or foreclosure, or you don't meet the credit score requirements of 620, then you still have a great option going with FHA. This will get you out of a home and you can start building equity, you can stop renting, maybe your quality of life would be better. So don't even second guess it. If this is your scenario, go with an FHA loan. However, if you also don't have a large down payment, maybe you're eligible for a conventional, but you're still better off going FHA. And this is what you can do. You definitely don't want to pay the mortgage insurance for 30 years if you don't have to. But you can initially apply with a FHA loan, and then in 5 or 10 years, once you've built up greater than 20% equity in the property, you can refinance it to a conventional loan. That is one way to get rid of that mortgage insurance once you've gotten the equivalent of the 20% equity in the home. Finally, if you have a high credit score and can afford that 20% down payment, you're already getting the lowest interest rates and avoiding paying mortgage insurance. So it makes sense to do conventional and not FHA, because with FHA, you would have to pay the upfront mortgage insurance of 1.75%. You can't avoid that by having a high credit score or a 20% down payment. Additionally, I want to tell you that you should do what is best for you. When you talk to mortgage lenders, they're going to try and steer you in a certain direction or tell you what is best for you. However, they might be telling you what is easiest for them. So definitely when talking to a mortgage lender, let's hear them out, get information from them, and then go talk to another one. It's free to talk to mortgage lenders, so I recommend talking to at least 3 and let them know that you're considering potentially a VA loan or an FHA loan or a conventional. Get the numbers, get the facts, and then ultimately do what is best for you. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, if you have any comments or questions and I'm able to help you, I am happy to do so. Till the next video, take care.